This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Saretsky here. Welcome back to the show. We got lots to touch on this week. We've got an update from the Fed. We've got US CPI inflation data. We got updates on financial markets, all of which are shifting rather dramatically, and of course will impact things like the Canadian housing market. So we're going to get to all that full circle as we prepare for Canada's CPI inflation data to come out next week, January 17th. So we really have to start this week's episode off with an update from the US CPI inflation numbers coming in right on the screws, right with market expectations. US headline inflation falling for, I believe it's now the fourth or fifth consecutive month. Headline inflation coming in, it's decelerating to 6.5%. Of course, actually falling month over month by about negative 0.1%. So a marginal decline on a month over month. But again, for the fourth or fifth consecutive month, headline inflation continues to decelerate, which, as you guys know that have been following this channel, that's been my view for quite some time. In fact, headline inflation is going to continue to decelerate because of rate of change base effects. Now, again, you have to keep in mind, because inflation went up so much last year, because prices rose so quickly, that it's hard to then comp and beat that rate of growth. So naturally, headline inflation is going to decline. Now, this doesn't mean that prices are getting cheaper. It doesn't mean when you go to the grocery store, your grocery bill is less. It doesn't mean when you go to book, an air flight, that suddenly it's cheaper to book. Okay, the absolute price levels are staying the same. In fact, are still going up. The rate of change. So if inflation falls back down to 2%, it just means prices are growing at 2%. They're not growing at 10% anymore. So headline inflation falls down to 6.5%. It's going to continue to decelerate, in my view, in the months ahead, as financial conditions have been tightening. You've seen rolling over in the ISM indicators, which are historically have predicted recession. So we all kind of knew it's been the most talked about recession coming into 2023. So it's no question that as the data rolls over, inflation rolls over with that. And that's really what the Fed has wanted. Now, what's interesting out of all of this is that the markets are loving it. Financial markets are loving it. They're saying, oh my gosh, look, inflation is, in fact, looks like it has finally peaked. It is rolling over. The Fed is going to have to be less aggressive. This means stocks are surely going to rally. Bond yields are going to fall back down. And so that's exactly what we've been seeing in financial markets. You've got this sort of bear market rally that's happening. Everyone's getting all excited, bidding up, of course, all the garbage equities that have been trounced over the last 18 months. Of course, are now rising. But what's interesting enough is, out of all of this, is that this is exactly what the Fed doesn't want to see. So the more that the stock market goes up, the more that bond yields fall, it becomes an easing of financial conditions, right? What the Fed wants to see is they need stocks down. They need, house prices down. That will ultimately help solve the inflation problem. And so if everything starts going up, right, you create this wealth effect. In fact, it's rather ironic that the Fed actually came out with a research paper just this week where they noted that home price gains over the last 2 years could have produced a wealth effect for homeowners that drove approximately 39% of the national increase in CPI non-shelter inflation. So, the rise in home prices didn't drive shelter inflation. It drove the non-shelter component of inflation, because what happens is, again, house prices go up, right? They go up in the US and they go up in Canada. People feel wealthier. They have more money to, equity in their homes to go and tap into, refinance, go buy the new car, the new boat, go on vacation, buy a second rental property. So the growth in home prices ultimately created, again, the wealth effect, which the Fed is saying is now largely responsible for the increase in inflation. So the easing of financial conditions, i.e., if we see a bottom in U.S. housing, or God forbid, prices were to start rebounding higher, that would not help the inflationary cause. So ironically, the easing of financial conditions, a rising stock market, actually provides the Fed, and for that matter, the Bank of Canada, more ammunition to hike rates should they feel necessary. So take these with a grain of salt. You guys know my view, which is I think that inflation is going to roll over. I think the economy is rolling over. I'm not as bearish on a lot of these financial markets, but I am saying caution is to be noted, because if financial conditions ease too much, this is going to give central bankers the wherewithal to continue to raise rates, because they say, well, we'll see. It's, markets aren't really reacting to what we need to do. Inflation isn't quite down to 2%, so thus we can continue to hike rates. So that's something to keep in mind, again, as we prepare for Canada's CPI inflation coming out January 17th. And of course, the Bank of Canada is scheduled for a January 25th rate hike announcement. The markets are still pricing in expectations of a 25 basis point rate hike on January 25th, around 70% odds. But again, coming back to sort of the easing of financial conditions is, one of the metrics that we've talked about a lot on the show that we've been watching is the Canada 5-year bond yield, right? Because that is ultimately what prices your 5-year fixed rate mortgages, more or less. And so since the start of this year alone, the Canada 5-year bond yield is down 40 basis points, right? So we should see a lowering of mortgage rates. And if you're a central banker, you're looking at this and saying, well, okay, hypothetically, if this were to continue to happen, if bond yields were to continue to go lower, and let's say you got mortgage rates back down to the low 4s or even into the 3s, for example, hypothetically, this would potentially stimulate the housing market. Again, it wouldn't necessarily create a rise in prices, but maybe you just have house prices stop falling. Maybe you get the odd bidding war back, and that would then create issues with the Bank of Canada's ability to fight inflation. So these are all things that are worth noting. The other thing to kind of touch on, we actually had an update as well from the banking regulator, OSFI, coming out. We've talked about again on the show that OSFI is reviewing. They are reviewing mortgage guidelines, so they're responsible for updating the mortgage stress test. So they're doing a review. So two things that they've actually proposed this week, where they said they're in active discussions. Now, this doesn't mean that anything is going to come to fruition, but it's things that they're chatting about. So one of the things is limiting the number of high income to loan ratios. So they're saying, well, there has been a large increase in highly levered borrowers, and so we want to be able to cap the banks, the commercial banks, how many total loans of this nature that they can issue at any one time. So it will basically restrict the amount of debt that they can issue to highly levered borrowers. So that would be, again, more credit tightening into a down market. The other thing they've talked about is having a more punitive or higher stress test for variable rate mortgage holders, because you'll remember what happened over the last 12 to 18 months. At the peak of the market in January of 2022, 57% of all borrowers that month went with a variable rate mortgage. And why did they go with a variable rate mortgage? Because it was about 100 basis points cheaper, and because of that, it allowed you to have basically a lower stress test. People were getting stress tested lower than they were at fixed rates, which allowed them to basically borrow more money, which allowed them to sort of get into the housing market. So the argument, again, is from OSFI as well. These are our riskier mortgages. Should we be putting a higher stress test on them? Now, what's interestingly enough is that today it's now the opposite. If you're going to get a variable rate mortgage, you're basically being stress tested at almost 8%, whereas a 5-year fixed rate, you're only being stress tested at about 7.5%. So I don't think that one's going to go in from OSFI. But again, the fact that they are talking about tighter credit restrictions going in or in the process of a down market is kind of counterintuitive, because kind of what you're taught in economic textbooks is that basically regulation should be pro-cyclical, which means that you should get out ahead of the 8 ball. So if you're the Bank of Canada, you want to ideally be hiking interest rates during the midst of the boom, not waiting for the boom to end and then hiking rates, which is exactly what the Bank of Canada did. And now if you're OSFI, if you're the banking regulator, you want to be sort of tightening credit in midst of the boom to slow down the rate of growth, right? I mean, let's not forget that at one point national house prices were increasing by 26% on a year-over-year basis, all-time record highs. So what they should have been doing is tightening. They should have brought in these tightening levers as house prices are accelerating, 10, 12, 13, 14, 15%. That's when they should have brought them in. You don't bring them in as house prices are then declining 9, 10%. Right now, again, naturally, we're down 16% since peaking. So it's interesting because, the policymakers, or you're kind of, you're taught, I suppose, to basically be pro-cyclical, but in reality, every sort of boom and bust has always been brought on by regulators actually doing the opposite and tightening in to downturns. So, it is rather interesting to see what's happening not only with the Bank of Canada, but with OSFI, really actually just tightening in to the downturn of housing. So we're kind of contending with all of this information. The Bank of Canada, I've talked about this before, but when we start to adjust for the levels of debt here, we can see that this is actually the fastest, the tightest hiking cycle, more so even than the 1980s when you actually adjust for the debt. So the fact that the Bank of Canada is still going and will probably go January 25th by another 25 basis points, again, shows you that they're kind of in the rearview mirror, which is what we continue to talk about here. So that's my personal view. Interesting to see how financial markets are playing out in light of optimistic expectations. I think maybe front running the Fed, but again, very, very diligent line here. I think that it is still wise and still prudent to be cautious here. We, I don't think we're through this bear market, at least not yet. In housing, equities may or may not be a different story, but housing, I think, continues to be something to be mindful of. And so this is going to, the easing of financial conditions again will put pressure on central banks to at least, if not continue to raise rates, at least leave them higher for longer, which at these debt loads is going to be painful for some. So as always, hope that helped. See you next week.